So in this lesson, now we want to talk about accounts receivable. We talked about cash as one of the first components of managing working capital. The second component we'll talk about is accounts receivable. Remember, accounts receivable basically is money that is owed us because we rendered a service, we sold a product to someone, and they owe us money and they'll pay us later. Like I'm a consultant, I render professional consulting services. At the end of the month, I prepare an invoice, I send it to the client pays me 20 days later. So I have an accounts receivable set up for that client. When I invoice them, that's amount due me, accounts receivable. So I set up an accounts receivable for that particular customer. Recall from the previous lesson when we talked about cash, remember we said there were two really important strategies or principles when it comes to managing cash. One was to make sure we disperse money very slowly at the very last minute. And the second thing that we talked about is collecting the cash from accounts receivable. So this principle, collecting money and putting it into a cash account, ties right back to how we manage accounts receivable. And also recall we went through some practices on how to manage cash. So what I'd like to do is talk about some practices you should follow when it comes to managing accounts receivable, just like cash. Again, working capital management requires that you manage each component. We have to have principles and practices to manage cash, receivables, and inventory. So now we're getting into the actual specific practices for all the components. That's how we manage working capital. And with accounts receivable, one of the first things you want to do is have a credit policy in place, written and enforced. For example, you don't extend credit to everybody. They have to pass through certain thresholds or scores. It's kind of like if you take out a mortgage to buy a house, the banker is going to sit down and ask you certain questions, and he's going to enforce a credit policy against you. And he may ask, well, what's your disposable income? And they rate you and they give you a score whether or not they're going to grant you that mortgage to buy the house. That same principle applies in business, which is when you do business with customers, you want to make sure they're credit worthy. So when you sell on account, so you may do a background check to see what their credit scores are before you issue credit to them. So credit policy, have a credit policy in place, enforce it against customers to make sure that you collect your receivables so that you don't have bad customers that you sell to. Now, if you have customers that you're kind of concerned about their ability to pay, for example, maybe you can't do a credit score against that particular person, you're a small business, and you've never dealt business with this particular customer, and this customer has maybe a large order, they would bring a lot of new business to your company if you could get the customer on board, but you're not sure the customer will pay you, then what you should do is require a deposit or an advance before you actually start to do the work. For example, if someone comes to me and says, I want you to do something, and I've never dealt with this customer or person ever before, I don't know whether they're going to pay me or not, I require 50% down before I actually start to do the project work. So deposits and advances are used where you have questions about the ability of a customer to pay. So once you have these policies and practices in place and you start to do business with these customers, then you start to invoice these customers. You need to invoice very quickly. So once you close out that accounting cycle at the end of the month, you can, once your receivables are updated and everything else, your work in progress accounts, all your systems and accounts are updated with all the detail, then you need to rapidly run your invoices and invoice your customers as quickly as you can, because the sooner you get the invoices out the door, the sooner you will collect the cash for the products that are sold or for the services that were rendered. So you want to invoice very quickly with your customers, as well as send out statements to customers who still owe you money. So you'll send out invoices as well as statements for balances outstanding that customers owe you. So one of the most important controls to help you manage accounts receivable is something called the aging report. So you want to age all of the customer accounts that make up the accounts receivable account. And we'll go through that with an example right here. And once we have this aging report in place, we want to monitor and collect our receivable balances from our customers. So accounts receivable, aging report, monitor, and collection. This fourth and fifth item, we'll use this aging report to help us execute on these last two practices that I'm talking about. So we have, these are our customers: Ajax, Bisque, Black Corporation, Carlin, Century City. So these are the customers that owe us money. We've rendered services to them. So we will age all of their invoices outstanding that we've issued to them. And if it's 0 to 30 days, it falls into this column. If they haven't paid us in 31 to 60 days, it falls into this column. 61 to 90 days, and beyond 90 days in this column. So you need to look at this and monitor this. And you can see that different customers have different agings in these columns. So you want to manage the customers a little differently depending on where they fall within these columns of the aging report. Like these two customers are pretty much current, and they pay, let's say they pay their invoices on time on a regular basis. So these customers, you may actually want to, if they do pay you earlier, for example, you may want to do a little bit of a goodwill gesture and give them a little bit of a discount to keep them current. So these are the kind of, this is what we want to see. We want to see very little off to the right and as much over here as possible. And the more it gets skewed over here, the more you're kind of in trouble with collecting cash and turning your receivables into cash. Then you have a customer who perhaps is somewhat delinquent, but not too delinquent. So what you can do, if a customer falls in this mid-tier area, you would try to contact the customer and work with them to see if you can sign, maybe they can give you a partial payment, or you can put them on an installment plan to work down these balances. So you work with customers that are kind of in this middle area in a certain way. And if a customer is really, really delinquent and they have lots of invoices and now it's really accumulated, let's say we have 6 different invoices and now all of the invoices are over 90 days, it's now up to $3,671, then you may have to cut off the services and no longer sell to them. And in some cases you may have to take some kind of legal action. So depending on where a customer falls in the aging report, you will basically do different kinds of collection practices, and it tends to get more and more and more aggressive as it falls way out here to the right. And these customers, this is what we want to see. We want to see customers that are very current. So accounts receivable aging report, very important internal control that you must have in place to manage your accounts receivable.